yes, we're going to see those rate hikes come, and everybody's raising that rate hike forecast now, even though the Fed Powell said 3 at his testimony yesterday. Goldman Sachs said it's going to be 4 now. They changed from 3 when we actually did our last podcast about 3-4 weeks ago. And now Jamie Dimon said, I'll be surprised if it's just 4. So you're seeing inflation. I think the market's expecting it, and hopefully if it moderates, it's probably going to be a positive. And maybe that's why you're seeing the markets go up right now.
I think that's exactly why. You hit it on the head with the narrative, and they got in front of this. They're trying to manage expectations. You hear this term a lot, this soft landing versus hard landing. A hard landing would be where they're jacking interest rates up and really shocking or surprising people of how quickly and how fast they're doing it. The soft landing would think of the concept of, hey, we can guide this lower. We're going to have some bumps, some volatility. But overall, it's all going to manage out smoothly, and then we'll turn back to growth and all that kind of stuff. Whether or not whatever side of the argument you take on there, the reality is everything is up, Frank. Markets are up, crypto's up, oil's up, gold is even up today. And the takeaway there is you have to pay attention to the narrative because, to your point, when things are, everybody hates uncertainty. Markets hate uncertainty. I don't agree with everything they're trying to do, and I don't think they're going to have a lot of success. But to your point, Jamie Dimon made a great comment. He thinks the consumer is very strong. This year is going to be great too. One of his comments he made recently at the healthcare conference was, quote, the consumer balance sheet has never been in better shape. They're spending 25% more today than pre-COVID. Their debt service ratio is better than it's been since we've been keeping records in 50 years. One more thing for you. You constantly pound the table in a good way about debt servicing. Don't just look at the amount of debt somebody has or a corporation has, but look at the ability that they have to pay that. So AT&T, everybody likes to talk about billions of dollars in debt, but they have billions of dollars in free cash flow to cover all those debt expenses. He's saying the consumer does. That's a big deal. That also helps the narrative of, hey, higher prices are here, but we're in good shape to handle this as long as they can control this 800-pound gorilla.
Yeah, and it's funny that you bring up AT&T because Joe is my nephew. I've had on the podcast a few times, and I was just going over a lesson with him saying, how to look at the numbers. And AT&T, I went over it with him yesterday and said, listen, everyone says AT&T, they're going to go out of business. They have so much debt, whatever, $170 billion in debt. And that's all people cite, but they don't look at the full balance sheet or the free cash flow coming in. And when I went over the numbers with him, I said, you're looking at the next 5, most of his long-term debt due in 30s, 40s, 50s, whatever that they took out. It's investment grade debt, which, is the easy way out, saying it's okay. But when you really look at the numbers, to service their debt over the next 5 years, I think it's $30 billion or something like that. They got $21 billion in cash. They're generating on average every single year, $25 billion in free cash flow, right? So $25 billion in free cash flow over the next 5 years is $125 billion. That's easily going to cover all of their debt due in the next 5 years, which is, I think it was 35 billion due. And they have 56 billion on top of that in liquidity. So, revolving credit lines and stuff. So you have to look at the full picture. I know it's a great story to say, holy shit, they got more debt than anything, but AT&T just gets checks every single month. Free cash flow is the money you get back when everything else is paid. It's remarkable. It's the cable companies. It's that constant payment coming in, and you have to look at both sides. And that's what Jamie Dimon was talking about, where you look at the consumer, their home prices are up 18%. The average price, just to go over, Daniel, so basic human needs such as food, heat, shelter, global food prices are up an average of 27%. Lumber prices. Remember, lumber prices are supposed to come down. Yes, they did come down, but they're up 40% in the past 4 months. Not a good sign with interest rates going higher. And we're looking at mortgage rates for 30-year at what, 3.6, 3.7? They were 3. I locked in at 3.2. Not too long ago. So it shows you how, rates are going up. You're looking at heating costs up 30%, oil up 43%. This is all year over year. And again, we're hoping this moderates. The consumer is in good shape. I mean, you're looking at household wealth is at record highs. And a lot of it has to do with, money being tied up in your house and that home value going higher. Wage growth is up as well at 5%. But, how long can this continue where what happens if we put price controls in, which was done when we had massive inflation? That means you're limiting the amount of money you can make, which is limiting the margins. Now you're not making those margins. Companies are able to pass off the higher costs, but what if they can't? And you're seeing that. You're seeing people change their habits right now, not going to certain restaurants and not going to on vacation, and saying, okay, maybe we'll wait. Or, when you're changing those habits, that's what you have to worry about, because if prices stay high, consumers may be, saying, okay, our expenses are up through the roof. Let's play it safe and let's cut back. And that could happen, and it is going to happen if inflation stays high. But I could tell you the Fed's really worried about, Daniel. And
Yep.
they should be. I like what they're doing now, because what did they do 9 months ago, 6 months ago, 3 months ago, which we said this is a joke. They're like, it's transitory to worry about. And we were like, F that. And we were like, there's no, everybody, you don't have to be a genius. All you got to do is not be an economist, and you got this right. Right? That's all you got to do. Don't be an economist, and you got this right. Because they're going to look at other things in the past. This has never happened before, when you're handing money directly to people. Most economists have a lot of money. They don't understand the markets. I don't even know if they do their own shopping or their own driving. Everyone out there saw the higher prices in every single thing that they did, and that wasn't going away. You handed checks directly to businesses. It wasn't like the credit crisis, where you backstop the banks. This money flowed directly into the system. It bypassed the whole working angle. It's, hey, you need money? Here you go. Here's a check. You got a couple kids? Here's a check. You got a business? Here you go. You don't have to pay it back in a PPP loan. It was going to result in inflation. We're hoping that, we don't see higher inflation, and, looking for moderation of this thing to come down a little bit, and that's going to be a positive. And there's a lot of hope there. But at least the Fed now finally is going over the top, saying, we got to do this quicker. Inflation is a problem. It's not transitory. So now that sentiment has changed, and it's resulted in a lot of volatility in the markets. But at least the sentiment is right now, where they're freaking worried, because they weren't worried, 9 months, 6 months, even 3 months ago. Now you can tell they're worried.
Absolutely. And you make a lot of good points there. For investors to take away from that, be boring. And Frank and I have joked about this, and I say this as a compliment. But today's, for Curzio Research Advisory subscribers, the new pick, I would say is boring. Frank, you're going to agree. I mean, hell, it's not that anybody hasn't heard of the company you're recommending.
Mm-hmm. Yes.
But it's very easy to overlook the forest from the trees type deal. And it's okay to be boring. I need to get better, Frank, and beef up the marketing side on how to be boring and sell that idea. Because last week when I was filling in for you, I talked about, can you think of a better stock in general to be boring and keep things as simple as possible for an inflationary time other than Berkshire Hathaway?
Yeah.
Inflation protection across railroads, transportation, insurance. Not to mention, I liked what you said earlier about AT&T and going out of business. As an investor, and I'm not talking about trading here, but as an investor, you want to talk about total risk of loss is your ultimate risk. Going out of business, going to zero. Berkshire has how many $100 and some billion in on their balance sheet. Mm-hmm. Google, real quick here, when I was in Ohio on my 3-week vacation, as you pointed out earlier, a friend of mine said, man, I want to be in the stock market. I'm tired of thinking about it. I put a bunch of money in Google. He was half asking my opinion, more just telling me. And I thought, well, that's smart, because you're picking a great, well-known, great business, and you're just going to camp out there. Frank, Google's trading at around 25 times forward earnings for next year. Its 3-year average, and again, take all this with a grain of salt, is 27. So you're getting it a little bit below its 3-year average.
Yep.
Again, are you worried about Google going out of business? And I'm not saying put all your eggs in one basket. I'm simply saying this is how to keep it simple, and it's okay to be boring. It's trading below its 3-year average on its forward PE. It's about 20% higher than the market of 21, but yet it's blown out earnings and revenue growth, and it has the optionality because of all the strength on its balance sheet, its huge high margins. It can do whatever it wants. Thinking about it and investing during tougher times, inflationary times, that's what I want to get across, and hopefully I think we can provide a lot of value to investors to think about that. Hey, tougher times, more tough environments are coming ahead. Inflation is a huge shift for the last several years in markets, and that's going to funnel down into markets, but you can still make a lot of money. And I don't want to say it's easy and sound arrogant, but you can make a lot of money off boring businesses that, to your point, just like, unless you're an economist or overthinking it, you can put yourself in a great position to benefit.
Yeah. And also, Daniel, when you're looking at comparing this to the 80s and where inflation was, it's a different time, to the point where you're looking at high double-digit inflation in the 80s, but you know what the savings rate was? It was like 8-9%.
Mm-hmm.
I mean, that's pretty cool. So if you have money, right, one, if you have money in the bank, higher rates are good. Your banking companies, your margins are going to expand. Insurance companies, it's good for. So, you're looking at even, you see oil companies do well, right? And that's, maybe not so much a function of interest rates, but more of a function of just, supply demand issues. So things do work in this environment, but now you're looking at rates skyrocketing, and let's see, with savings rates and, inflation was still, negative in the negative. But, people failed to mention that when, in the 80s, holy shit, getting a mortgage, 18%, whatever it was back then,
right,
in the early 80s. But, your savings rate, I mean, 8-9% is pretty cool. So,
well, not to mention, I mean, we're not huge bond guys, but hell, if interest rates spike and you could go park money in something and earn 8%, why the hell wouldn't you?
Yeah.
I mean, we love stocks. We're always going to find great stocks like that. But hell, we'll be the first to tell you, yeah, go buy a CD for 3 years and earn 8% annually.
And
absolutely, it's about compounding money. It doesn't matter what vehicle you use.
Listen, guys, it's if you look back at history, it's been value, then sometimes growth, value, sometimes growth. It's been a pure growth market, right, Dan? It's been a pure growth market since the credit crisis. Like growth stocks just outperforming, and that's fine because you had interest rates super low. More money into the system, but now you're seeing the transition into the value. You're not seeing the transition out of the market completely. The S&P is not getting smoked. There's certain areas that are getting smoked, right? So you have to be careful. But when I look at, you mentioned the stock being, boring to the point where people know it. But when you see the story and you see the video for CRA, which comes out today, it's very, very exciting because this is a company that's growing tremendously. It's trading at a much cheaper valuation in the overall market, yet it's going to be competing and right now taking market share from NVIDIA, which is an $800 billion company, right? So, plus seeing this company at CES, it was remarkable. But more importantly is they're paying a dividend. Dividends are going to come into play now. Dividends are going to be huge now. Yep. So if you're paying a nice yield, you have lots of free cash flow, you're buying back your stock, which you're going to see massive buybacks. A lot of these companies have a lot of cash on their balance sheet. Buybacks are good. I mean, you look at where the market is. Where's the S&P? It's up 3% off its highs. All the companies that bought back their stock for how many years? It was a great buy on average, right? I mean, a lot of these guys, Apple's buying back their stock. A lot of these guys buy back their stock, right? Reduces the shares outstanding, increases, your share percentage wise, but it's, of ownership. And you're seeing that benefited these companies. Lots and lots of buybacks are going to come over the next year. You're going to see probably record buybacks this year, which is going to put a floor on some of the companies, which means be careful buying high growth names that, are expected massive growth, 5-7 years. ESG companies, you're looking at marijuana companies, you're looking at EV companies, right? Tesla's going to get away with it. It's fine. They're growing still. Tesla's the only company out there that really has a car on the road. All these are coming. Let's see if they come and how they do, the manufacturing part and getting these things out. I still don't know how they're going to do that. In the year time frame that they're expected, the year 18-month time frame. But a lot of these companies and their growth models going out really, really far and not worrying about earnings and just saying, hey, we're going to see sales growth, but we're going to report huge losses. Those are the ones that are getting hit the hardest right now because it's not going to be as easy to borrow money. It's not going to be easy to raise money as, capital is going to get, harder to come by as you see higher rates. It's not going to be as much as an easy monetary policy, but that's what's going on now. It's more of a shift in allocation, not, hey, run away, run for the exits. Holy shit. But a lot of you are probably sitting on companies that are down 35-40% that just got wrecked if you were a little aggressive. However, those are the same companies that are probably up 200-300% off their lows during COVID. So you have to look at it that way.
Well, doesn't that depend on when you bought? Tell that to the people that bought recently and are down.
I know.
That's it. Hey, that's the world we live in.